One is a white paper that we just put out, written by my colleague Ed Tom, called the VIX Decomposition. And basically, what it does is it takes the VIX index, which I think most people are very familiar with. Sometimes they call it the fear gauge. It goes up basically when the market tends to sell off sharply. It goes down when we rally. There's a relatively strong negative correlation. However, what Ed shows is actually about 20% of the time, it is not negatively correlated. There's days where the market goes up and VIX goes up and vice versa. And the approach to a decomposition is relatively straightforward. We basically divide the SPX options that are used in the VIX calculation into 6 segments. So if you think about it, you have at the money vol, you have the far tails on the call side and the put side, you have the meteor 20, 25 delta options or so. And what we're seeing today with the VIX up almost 4 points is a little bit interesting. We're actually seeing a pretty solid spike to a parallel shift of the SPX, the volatility surface at that 30-day term. But we're also seeing some interesting upside convexity increase, meaning that the far out of the money call wing volatilities that go into the VIX are actually leading things a little bit. And I was just talking to another colleague about why this might be. And, today's also the tariff deadline after the last pause, and that also might be contributing to the sell-off. But we all know what happened when those initial Liberation Day tariffs were modified or stalled, and the market exploded higher on April 9th. So it's possible that we're seeing some upside interest in the case of some sort of a pretty sharp bounce like that.